We'll follow the same format that we did from the last two chapters, where we'll cover chapters 10 and 11, usually in 2 days each, like a week on each. And then we should have time for review before we test and everything. Okay, so in chapters 8 and 9, we dealt with current and long-term assets. So we were dealing all with assets. So now we're going to shift gears and look at liabilities. So chapters 10 and 11 are both going to deal with liabilities. So in chapter 10, we're going to look at current liabilities, and it is kind of a longer chapter. So we'll see how much we can get through today, because we're going to look at notes, but notes payable. So instead of, notes that are due to us, we're looking at notes, money we owe to other people. But the good news is your calculations for your interest are all the same. So you've really already learned, your face value times your interest times your time and days over 360. That all stays the same. The only difference is now we owe instead of it being owed to us. So we're going to look at that. We're also going to look at current liabilities as far as what we owe our employees for wages, and also like taxes on employment. And then we're going to look at installment notes. So installment notes, of course, would be more like a mortgage or a car payment, where we're making equal payments, and some of that's going to interest and some of that's going to principal, okay? So the difference between that and notes, we know notes, they're usually the full amount, the face value plus interest is due in 90 days or 120 days or something like that. Whereas with installment notes, we're making regular payments. So it could be usually monthly, but it could be even yearly payments. And our face value that we're paying towards, or the principal amount we're paying changes with every payment because our interest gets recalculated. But we'll look at those and how to set those up. And we'll talk about contingencies just a little bit as well. So just like a current asset, we can have a current liability. So a current liability is just a liability that we owe within the current period or the current year, okay? So whoever's lending the money is the creditor or lender, makes sense, right? And then the person that's receiving the money is the debtor or borrower. So in this case, in this chapter, we're going to be the debtor or the borrower, okay? And then we're going to borrow money from a bank or a company, so they'll be the creditor or the lender. And we already know debt is recorded as a liability. So, in the past, we've really used accounts payable has been our big liability account when we purchase on account. And then we also have like unearned revenues were a liability that we dealt with in college accounting procedures. And if you remember unearned revenues, do you guys remember what an unearned revenue is?
Someone pays us, but we haven't done yet.
Yeah, very good. That's exactly what it is. An unearned revenue is when a customer has paid us up front and we haven't done the service yet or provided the goods, okay? So instead of owing them money, we owe them the service or the goods, okay? Very good. So again, we're going to be dealing with some newer or different types of liabilities, our big one being notes payable. And then again, we're also going to look at wages payable and salary expenses and things like that. So long-term liabilities we'll actually deal with in chapter 11, so next chapter. But in this chapter, again, we're dealing with current liabilities. And we talked about most of those. So let's talk about our short-term notes payable. So short-term notes payable are notes that we've issued to other companies saying we owe them money, or, it's always money, but either cash that we've borrowed or, we're taking an accounts payable and turning it into a note, okay? So those are the two big things we get out of a note. So again, the big difference between accounts payable and notes payable is interest. Okay, just like accounts receivable and notes receivable. So we have to pay interest. So instead of it being revenue for us in this case, it's going to be an expense. When we calculate interest, it's going to be an expense to us. So let's look at one. For example, Nature Sunshine Company issued a 90-day 12% note for $1,000 dated August 1st to Murray Company for a $1,000 overdue account. So we're Nature Sunshine Company, and we issue a note to Murray Company saying, hey, we can't pay this account's payable. We know it's overdue, but if you give us 90 days, we'll pay you the principal or face amount plus interest. So when we issue the note, in this case, we debit accounts payable because we're getting rid of the accounts payable, and we credit that liability account notes payable. Okay.
So this is us paying it?
This is just the issuance of the note, but yeah, we're going to owe it. Yeah, we owe it. So what we're saying is, this is in August 1st when the note was issued. So in 90 days, we're going to pay them $1,000 plus accrued interest. Okay. So issuing the note, debit to accounts payable, credit to notes payable. This will be your note issuance journal entry. The only difference would be is if we borrowed money, then we would debit cash instead of accounts payable. Okay. So when that note matures in 90 days, we're going to record paying back the face value plus the interest. So we're going to calculate interest. Again, it's the same interest. So you're taking your face amount of $1,000 times your 12% interest rate times 90 days divided by 360 days. So for this note, it's earned or accrued $30 worth of interest. So when it matures on October 30th in 90 days, we're going to pay $1,000 plus the $30 of interest. Okay. So notes payable gets debited $1,000 since we're paying it off, we're clearing off that debt. Interest expense gets charged the debit of $30. So interest expense is just like any other expense account. And then cash gets credited for the principal plus the interest. Okay. So again, the difference between a note receivable and a note payable is that we're paying it. So interest becomes an expense to us, and cash is going out the door. So a couple of things it tells us about that interest expense. Interest expense is reported in other expenses on the income statement. So it's just an expense. It's reducing our profit. And interest expense account is closed at the end of the year. Well, that's typical of all expense accounts. Remember, all revenues and expenses are temporary accounts that get closed out at the end of the year. So you can probably imagine, just like with notes receivable, if we issued a note at the end of the year that matured next year, we would have to deal with accrued interest, just like we did on the receivable side.
And we're debiting notes payable because it's a liability?
Yes, yeah, so
account?
it's, yeah, like when we issued the note, we credited notes payable. So yeah, when we debit it, we're clearing out. Yeah, you got it. Yeah, we're paying it off. Very good. So each note that is written, that is issued, affects both the debtor and the creditor. Okay, so it's, you know, we learned last chapter, well, chapter 8, how it affected the lender. We were the lender in that case. You know, we were issuing notes receivables. So now, you know, we're going to look at from the borrower standpoint. Okay, so it's affecting both the borrower and the creditor. So some of these slides are kind of nice just as nice review slides to look at different transactions and how they're affecting both the borrower and the creditor. So again, the creditor is what we did in chapter 8, but here it is as a review too. Okay, so for example, on May 1st, Bowden Company purchased merchandise on account from Coker. Well, that's just a typical purchasing inventory. Okay, we reviewed that in chapter 8. So if I'm purchasing inventory, I'm debiting the asset inventory and crediting accounts payable. And then the creditor, the one selling it, is debiting accounts receivable and crediting sales to recognize the sale. And then they also have to recognize the cost of goods sold. So cost of goods sold was debited and merchandise inventory credited for the $7,500 cost. Okay, so that's looking at both the borrower and the creditor part. Well, 30 days passes and Bowden realizes they can't pay that $10,000. So we're going to pretend we're Bowden in this situation. So then we're going to say, hey, we'll give you a note for 60 days at 12% interest, and then in 60 days we'll pay you this full balance. Okay. So showing us what we just went through basically on the last couple of slides. When we issue a note to cancel out or clear out what is due to us, or what we owe. We'll get it right. We're going to debit accounts payable and credit notes payable. So we're just changing it from an accounts payable to a notes payable. So when we issue the note, it's always just issued at the face value or the principal value. And same for Coker, the creditor, but they're having it as a notes receivable and crediting accounts receivable. And then again, in 60 days when that note matures, we are paying them the $10,000 plus interest. So they calculated interest, 10,000 times 12% times 60 divided by 360. So this one cost us $200 in interest expense. So we debit notes payable to clear off that debt since we're paying it. Debit interest expense 200, and cash is credited 10,200. Okay, so that's what we're paying to settle this note. And then the creditor is receiving the cash. They're notating that $200 as interest revenue, a credit to interest revenue, and notes receivable gets cleared off with a credit. So again, you know, the ones in the right-hand column are things we dealt with in Chapter 8, and now in Chapter 10, we're dealing with from the borrower side. So when you're doing the homework or even on the test, just try to think about, okay, am I the one borrowing the money or am I the one receiving the money? You know, that way you get your journal entries correct, because it can get a little confusing, right, when we're looking at two sides of the same transaction. Again, like I was saying when we were doing the first issuance of a note, we can also just borrow money from the bank. So we're talking about short term here. So we go to the bank and we're like, hey, we just need a few $1,000s for 90 days or 120 days, whatnot. And so the same principles apply. So assume that on September 19th, Iceberg Company borrowed cash from First National Bank by issuing a 4,090-day 15% note to the bank. The entry to record the issuance of the note is as follows. So again, when we first issue the note, in this case, we're getting cash. So we debit cash for $4,000. And then we owe it, so we credit notes payable. Okay. So same idea here. We're just looking at debiting cash instead of accounts payable. When that note is due on December 18th, it's the same entry as it was before. We calculate our interest, 4,000 times 15%, times 90 over 360 gives us interest of 150. We debit notes payable, 4,000. We debit interest expense, $150. And we credit cash, the face value plus the interest. Okay. So it doesn't matter if it was on account, like to settle an account or to receive cash, the payment is the same. Okay. Let's stop right there and go to our practice. So if you haven't already, go ahead and log into Canvas and open up that Chapter 10 practice. So Chapter 10 practice. And we'll do the first one together about issuing notes payable. Okay, so the very first one in our Chapter 10 practice is entries for notes payable. So on this one, we're going to look at the journal entries from both the borrower standpoint and the creditor standpoint. So what we just kind of went over. So it says Bennett's Enterprises issues a $400,000 90-day 5% note to Spectrum Industries for merchandise inventory. Okay, assume a 360-day year, and then leave it blank if there's no amount. So right now we're looking at Bennett Enterprises entries to record the issuance and the payment. So Bennett's the borrower. When they say that we're issuing a note, the person issuing the note is the borrower. That terminology gets kind of confusing, right? But the person that's issuing the note is the borrower. So Bennett Enterprises is the one issuing the note. And in this case, though, it's for something we didn't see in the slides. It's for merchandise inventory. So instead of extending in a past due account, we're just going to actually buy inventory on account, on a note. Okay. Well, inventory, what kind of account is inventory?
Asset?
It's an asset. Good. So when we purchase inventory, do we debit or credit it? Debit. Okay, very good. So when we issue the note here, since we're paying for inventory, we're just going to debit inventory, the 400,000. Oh, not 4 million. And we're going to credit notes payable. Make this a little bigger. There we go. 400,000. Okay, so inventory gets debited and notes payable gets credited. So again, our debit is a debit account can change based on what we're issuing the note for. It could be accounts payable, it could be cash, or in this case, it's inventory. Okay. So there we've calculated the issuance or journalized the issuance. The next thing we need to do is calculate the interest, right? So what would I do to calculate interest?
400,000 times 5% times 90 over 360.
Perfect. 400,000 face amount times the 5% annual interest rate times the time, which is 90 over 360. Okay. So again, our interest calculation is the same. How much interest have we accrued on this note?
5,000.
5,000, perfect. And we have $5,000 in interest. Very good. Okay. So when we pay this note at maturity, what do I debit?
Oh.
Yeah, notes payable. Good. Yeah. Yeah, that's when it gets tricky, right? Because we go back to being the receiver. So yeah, notes payable gets debited, the face value, the 400,000. Do I debit anything else?
Expense.
Yeah, very good. The interest expense, right? So I'm going to debit interest expense, and we calculated that at 5,000. So interest expense gets debited 5,000. And then what do I credit? Cash. Perfect. Cash gets credited for how much? Perfect. 405,000. We're paying the original face value plus the interest. So that's from the borrower's standpoint, the one issuing the note, the one borrowing. On part B, it wants us to do the journal entries from the creditor standpoint. So this really is going back again to chapter 8. So Spectrum Industries received this note. What did they debit and credit to receive the note?
Notes receivable and sales.
Very good. Notes receivable got debited, 400,000, and sales was credited. Now what they're not showing here is that second journal entry that we would recognize the cost of goods sold. You know, they left that off, but just know that that would be there too. And then what about the receipt of the payment? What would Spectrum journalize?
Exact opposite.
Right, it's almost the exact opposite,
Yeah.
right? Yeah, we start with cash, right? We receive cash.
Instead of interest expense, it would be revenue.
Very good. Yeah, we're just going to kind of flip-flop and change the terms around just a little bit. So cash, well, how much cash did they receive? 405,000. Very good. And then you said, I think they want us to do the notes receivable next. So notes receivable gets credited to clear off that face value of 400,000. And then as you mentioned, interest revenue gets credited 5,000. Okay. So pretty much the reverse of the borrower side. Okay, so cash gets debited 405,000. Notes receivable credited 400,000. Interest revenue credited 5,000. So those were the entries we learned in chapter 8. Okay. So chapter 10, we're learning more on the borrowing side. Any questions on those? So really it's just remembering when we're the borrower that it's notes payable and interest expense, right? But otherwise the format and everything is pretty similar. Okay.